Now staying with economic news, and government-led measures aimed at slowing the explosive pace of mortgage lending in Korea were introduced earlier this year. And while they've proven relatively successful in curbing lending at the nation's biggest banks, some negative effects have emerged. Shin Se-min reports.
The government's introduction of tougher lending requirements was meant to control Korea's mounting household debt, but it has sparked some issues of its own. In February, the Financial Services Commission stepped in, ordering commercial banks to start screening mortgage applicants more carefully. Under the Commission's mandatory guidelines, banks are required to base their decision on a household's ability to repay the capital and the interest together. Before banks could lend money provided, they were confident the applicant could cover the interest alone. The move came as Korea's household debt reached an all-time high of $1.02 trillion in February, growing $104 billion in the space of a year. The Bank of Korea says the pace of mortgage loan growth from commercial banks slowed by $1.6 billion in the first 3 months of the year compared to the same period last year. However, loans taken from secondary-level financial institutions, where interest rates are generally much higher, hit $217 billion as of February, the highest figure tallied since the central bank started collecting related data in 2003. On top of that, the property market, which got a boost from a government-led stimulus package, appears to be in a downturn. In its latest report, the Korea Development Institute said home transactions dropped over 26% in the first quarter on year, below the 5-year average. Experts say purchasing sentiment was dragged down by the new lending guidelines. Shin Se-min, Arirang News.